Hi there. In this video, I'm going to be looking at the influences on financial management, more specifically, external long-term sources of finance, still looking at debt. Okay. Now, again, looking at long-term borrowing. This is to finance larger projects, buying real estate, buying equipment, buying some sort of facility, and it's something longer than 2 years. Okay, greater than at least 12 months, but greater than 2 years generally. And these ones here would fit into the non-current liability section of a balance sheet. Now, one of the long-term external debt finance instruments will be mortgage. Okay, this is a loan that's secured by the property of the borrower, which would be the business. So basically, it's secured against the real estate you're buying. If you want to buy a new factory and it's going to cost you $1 million, if you don't pay your repayments through the regular repayments over the agreed period of time with the interest and everything as well, the bank or the institution you're getting it from is going to most likely repossess it, okay? So that loan is secured against that. That's your security, okay? Your actual physical structure you're buying, which they'll then take, essentially, okay? The issue with this is, however, it incurs interest. However, being spaced over, let's say, 20, 25, 30 years, whatever the mortgage length might be, the interest rate is generally quite low if it's fixed. If it's variable, it will obviously vary with what the official cash rate is, but it allows you as well to budget and work out exactly how much you'll be paying in the future, and you can budget accordingly. Another long-term external finance instrument is debenture. Okay, these are issued by a company for a fixed rate of interest and for a fixed period of time. Now, rather than a business going to the bank and saying, "Can I have the money?" this is actually issued by the company itself. Okay, so it's basically I guess an IOU that the company is issuing to other people. Okay, so they'll say, we're looking for investors or we're looking for finance. Give us, I don't know, $500,000, and in 5 years' time, we'll give you back the $500,000 plus 10% interest. Okay, and on the day, on maturity, the company buys back the debenture, so buys back the IOU, or the bond, or whatever you want to call it, buys back the debenture, and they pay the person who bought it the $500,000 plus the 10% interest. Okay, governments do this quite regularly as well to finance infrastructure projects. Okay, if they want to build a new bridge, build a new tunnel, something that is going to benefit the community, but they need the money to do it, they might actually issue government bonds, basically debenture, and say, give us $20,000, and in 10 years' time, we'll give you back the $20,000 plus 5% interest. It's quite a stable form of investment as well, by people, if the business is credible. If it's for a government, generally it's an extremely good investment because the likelihood of governments going bankrupt is quite low. However, with companies, there's always an element of risk. However, it is a form of external finance that a company could use. Okay, drawing on just general, everyday people, really, or other companies. Other companies might be buying it as well. And we've also got unsecured notes. Now, this is a loan for a set period of time. However, there's no security. Okay, as it says unsecured, there's no security. It's not backed by any assets or any collateral. Therefore, it's got the most amount of risk to the investor. Okay, and because it's not backed by any collateral, it's usually got a very high rate of interest. Okay, so compare this to a mortgage, which is a secured loan. That mortgage might be secured against your factory. So if you don't pay your repayments, they'll just repossess the factory. Okay, in a nutshell. But that means that they can offer you a lower interest rate as well, because one way or another, they're getting their money back. Okay, with an unsecured note, there's no security. It's not backed by that, that factory you want to buy. So because there's a bigger risk for the person giving you the money, they're going to charge you higher interest because they need to try and, again, find a way of making money from giving you that loan. Okay, money's not free. And then the final type of external long-term debt finance instrument is leasing. Okay, a lessor purchases or owns equipment, and the lessee, the business, pays to use it. Okay, in a nutshell, it's kind of like renting. Okay, you're leasing something. For example, I might be the lessee, a business. I can either approach a bank or a leasing company and say, we need a machine. It's going to cost me $20 million. I can't afford that, so I don't have the huge amount of capital required for it. You buy it on my behalf, okay, and then I'll pay you installments, or I'll pay you basically rent in order to be able to use it. So they'll buy it for me, and then I'll pay them back maybe $1,000 a week or $1,000 a month until it's all paid off. Okay, so it allows the business to use equipment without a huge capital outlay, meaning that rather than, handing over $20 million in one hit, I can then use whatever money I've got left to put towards other projects, other activities. But it also allows me to budget. If I know I'm going to be spending, $1,000 every fortnight, I can build that into my budget, and I know exactly how much I need to have available in order to cover that payment. The next video is going to look at sources of finance. However, rather than external, it will look at internal finance, internal equity, and it will also look at external equity as well. However, I hope this video on external long-term debt has been valuable. Thank you.